I'm here at the ACG Manufacturing and Logistics Conference in Midtown Manhattan, and I'm joined by Scott Budoff, partner of Sawmill Capital. Scott, tell us, I guess, a little bit about what you folks are doing and seeing right now in the manufacturing space.
Sure. Well, Sawmill Capital is a private equity firm. We focus on the lower middle market. We've been in business since 1997, and we focus on businesses that are predominantly in the manufacturing, industrial distribution, and industrial services space. And our focus really, when we get involved with the businesses that we choose to invest in, is to look for opportunities to work in concert with the management team to really improve the businesses and really be able to implement best practices across not only their manufacturing and distribution and service footprints, but also to really focus on proactive growth and growth through acquisition. But most important, what we find in the lower middle market is many of these manufacturing businesses that we get involved with are trying to do too much without enough resources. By bringing us in as a partner, what we're able to do is help them focus on really the key mission for the business and then be able to marshal resources, not even capital, but people resources and capabilities around that central mission to really be successful.
All right. What I guess would you say would be the commodities and factors that have been most affecting the sector over the last 24 months?
You know, it's an interesting time, right? I mean, we're coming up in September on the 5th anniversary of Lehman's failure. And so you kind of look at that as a bellwether event that really changed the entire environment. And what we saw from 2008 through 2009, it was a very rough economic environment, which not only made it difficult for our portfolio companies and everybody's companies generally, because we had a synchronized recession around the world, but we also had a real, as you would imagine, a corresponding reduction in M&A activity. So not only was it difficult from a portfolio management standpoint, but also from an acquisition and sourcing standpoint. As we came into 2010, we saw the environment improve, both for businesses and also for M&A. And really, we had a pretty nice run in 2010, 11, and into the mid part of 12 as the capital providing landscape stabilized and started to improve. The deal flow improved because people that had businesses that had fared well through the cycle were now looking to monetize those investments. And so there was a lot of high quality deals on the market that we were able to look at and transact in. And that was a very good period for us. Interestingly, what we saw coming into the summer of 2012, and really for the last 9 to 12 months, has been a real slowdown in deal flow activity. The economy is stable, and we haven't seen any major upsets one way or the other. Certainly lots of fears and scares between the changes in the tax code at the end of last year, the implementation of sequestration, and certainly there's no shortage of reasons to be concerned in Europe and in Asia. But for the most part, businesses at our end of the economic cycle have fared pretty well and have been pretty stable. But deal flow from the standpoint of new opportunities that we're looking for really took a slowdown. We saw quite a bit of that activity get pulled into the first half of last year as people were worried about the tax changes and wanting to get those deals done before those tax changes got implemented. And as a result, a lot of deal flow got moved forward and then wasn't really replaced. And so we're just now in the last 30 to 60 days, starting to see deal flow start to recover. And that bodes well for the second half of the year, but it's tentative still, and it's hard to really predict what the rest of this year is going to look like from that standpoint.
It's kind of been suggested to me that whatever Ben Bernanke's decision is going to be regarding things and factors like QE is going to have a much bigger impact than, say, the price of steel in any given market. However, getting away from that a little bit, is there any kind of piece of legislation or policy decision that you feel is really going to impact the industry going forward?
Look, we're dealing with businesses that are, in some respects, somewhat insulated from all of those factors, and in somewhat, nobody's insulated from any of the factors. Certainly, we worry a lot about the changes in healthcare. That certainly raises the cost. It creates challenges for our managers and certainly for our companies. But we believe that providing strong benefits packages is a way to differentiate ourselves from other companies. And so we use that as not necessarily, yes, it's an increased cost, but it's also a way for us to hopefully attract talent and retain talent as compared to other companies that maybe don't share that philosophy. So although we worry about it, we worry about lots of things. And you reference commodity prices, and certainly as raw material prices change, we have to be smart about how we deal with it. I think that, though, if you go back over the last 5 years, one of the things we saw happen was the markets have adapted to all of these extreme fluctuations we've seen in commodity prices, and as a result, surcharge mechanisms and price adjustment mechanisms have become fairly refined and really do take into account those changes so that you're really focused on the value add that you're bringing to your customers, as opposed to necessarily those commodity fluctuations. Now, of course, if you have extreme fluctuations in any one commodity, fuel, steel, any of the metals, plastics, and we're in all of those markets, it certainly has short-term impacts on demand, but certainly for the longer term, things tend to level out and be more driven by the economic activity than by the commodity price exposure.
All right. I feel like I'm at least in your camp on this one, that we got off to a very slow start in terms of deals to begin the year. You kind of have the impression that a few other folks have shared with me, which is that there's an expectation that deal flow will pick up again. Where have you seen sector multiples so far, and maybe how does that compare to the last 12 to 24 months worth of activity in the sector?
Yeah, it's a very, again, we're in such a, I've been in this business for 25 years, and we're certainly no stranger to cycles. It's a cyclical market. There's constant cycles that run with the capital market cycles that will impact both our ability to enter and exit investments, as well as our ability to influence the outcomes of those investments. We are now in a situation where we have many potential buyers in the market. It's almost a perfect storm in that we have capital providers that feel like for several years they were on the sidelines, as they now are recovering and their balance sheets are recovering. New entrants into the markets, CLOs and hedge funds that failed during the market dislocation that have now been reconstituted and raised capital, and they're in the markets. And so you have plenty of liquidity available from a debt capital perspective. The terms are good, the markets are opened, and there seems to be a lot of availability to do transactions. At the same time, the equity capital side of the equation is also extremely strong, with both private and public corporations with large cash balance sheets, as well as private equity firms that have cash that has to be deployed or will no longer be available. And certainly they have lost ground well during that 2008-9 period we talked about. There was not investment activity to be had. So you've got a lot of equity chasing deals, you've got a lot of debt capital chasing deals, and then you've got a shortage of deals available to be executed on. Well, you take those three factors, and what you wind up seeing is certainly multiples are at quite high levels for all businesses across the sector. Certainly what we see is a tale of two cities, in that if it's a good business with a good team, they perform well over the last several years, they're trading at extreme premiums to what you would typically expect market averages to be. At the same time, there are certainly no shortage of companies that come to market that have issues associated with them, and those issues certainly do, although they ultimately transact, they wind up driving both elongation in the period of time it takes to transact, as well as the amount of work that needs to be done from a diligence standpoint to really make sure they understand the issues. Because I think one thing that has certainly come out of the dislocation is that whether it's lenders or private equity firms, there is an extreme emphasis on doing proper due diligence and making sure that you understand the issues and the factors that are going to influence success in the investments that you're making.
Getting to the lenders now. One of the broader senses that I've had from the beginning of this year is that there's been a lot more debt financing and dividend recaps going on in private equity than there were during the last quote-unquote boom years. It seems to me that I guess this is in part fueled by some PE firms needing to go out, take out the older debt, and put something in place that is obviously cheap to the point that it's at historic lows. Is that kind of the sense that you're getting in the manufacturing space too?
Well, I would say that the manufacturing space is not unique in this respect. It's really private equity and company-wide. Certainly, if you have two choices for liquidity. One is to sell your business, and the other is to, if you've built up equity value, to look at refinancing it and being able to not only take care of taking advantage of the current market conditions and putting in place a better capital structure, but certainly if the opportunity exists itself to take capital off the table in the form of a dividend recap. And we are participants in all of those transactions. We certainly evaluate every one of our companies relative to our long-term potential to create value and relative to the short-term opportunity to meet our investors' needs for the return of capital when it's available. And so certainly at times when you're drawing capital from your investors, they're happy to provide you with that capital, but they also have an expectation that that capital is going to be returned. And so any opportunity to meet that need is certainly something that we look to accomplish within the scheme of what is best for the investment, best for the company. And certainly there was a lot of discussion, not so much in the last 6 months, but 12 and 18 months ago, about how private equity firms were leveraging up businesses and not necessarily leaving them in a healthy state. And I just found that conversation to really not ring true in terms of my experiences in the market. I'm sure there are some bad actors and some experiences that would support that point of view, but for the most part, Lenders are very, very sensible. They're not over-leveraging businesses just because somebody asked them to. They're putting what they think is proper leverage on relative to the risk profile of their investment. And certainly private equity firms are not interested in getting involved in situations where they can take out some of their capital, leave some in, and then have a non-functioning situation where they lose control of the investment or have to spend a lot of time going through amendments with banks. So I think what I would say is that the market has equilibrium, that there is, on all sides of the capital structure, there are strong participants that are reaching a good equilibrium about what's right for the company, as well as the management teams that are sitting right there at the table having those conversations with their equity partners and with their lending partners to make sure that a balanced situation is achieved. Now, certainly if the company underperforms, certainly if there are economic distress or unexpected problems, that can cause that equilibrium to go out of balance, and certainly when it does, then you've got hopefully capital providers at the table that are able to come in and help work with management to put the situation back in equilibrium. And certainly we participate in those circumstances as well.
All right, all great points. Thank you for joining us very much.